It's July, and we have another Austin real estate market update for you. I'm David Shapiro with my colleague Lee Abraham of the Shapiro Group here in Austin, Texas. We're a real estate team. So if you're thinking about buying, selling, investing, go ahead and reach out to us. Info is below. And this month, we have some new charts for you. We are looking at trend lines, kind of thinking like, what if the price of Austin were to have just continued the rate it was on from 2011 to 2019? Where would prices be? How far below that trend line are we? Is there still a big drop in prices to come or not? And how does that all play in? And this is the stat that I think people are feeling the most, the fact that there's less transactions. And so I just wanted to do a little bit of a longer term analysis and look at this in a different way. Here we have it for three counties, Travis, Hayes, and Williamson, which make up the majority of what people consider the Austin metro area. Over this period of 14 years, we've got 450,000 listings. And then here we have the city of Austin for that same period, about 200,000 listings. So just a little bit, half of the activity is within the city. And you can see the trend line I put here in red. It was a little bit of a more aggressive trend line to moving upwards outside of just the city because there's more ability to add inventory, add new homes. And so the number of transactions was growing at a faster pace than within just the city. And you can see here, if we were to continue along this trend line, we probably should be somewhere above 40,000 transactions a year. And right now we're below 30,000. So that's more than a 25% drop off in the number of transactions in this three county area. And if you look at the city of Austin, we should be about 17,000 transactions. And it looks like we're going to do right around 10,000. So an even bigger drop off percentage wise within the city of Austin. And it's just fundamentally, I don't think anything has changed from 2020 to now in terms of what makes up the city of Austin, why it was a desirable place for people to move over all these years. These things haven't changed. Still tax free. It still has mild winters, right? The cost of living is still lower than New York, San Jose, San Francisco, Los Angeles, a lot of these places that people are moving. So I don't think the story has changed in a significant way. If anything, there's more jobs, there's more opportunities, there's new headquarters here that have been announced, and that continues to grow. The number of jobs here continues to grow. And so what story does this tell for those of you that are thinking about, okay, what's next? Like, look at all this. This to me, this gap here is pent up demand, even bigger here within the city of Austin, the people that would have been buying if interest rates had not gone up so drastically. And so I don't think those buyers have just disappeared. Maybe they've moved to renting for longer. And so our take is that there's a lot of pent up demand, that when interest rates do come down, these people are going to move into the market as buyers.
And so totally agree with the assessment. What's the strategy? What's the plan to interpret this data and make it work for you? It's to be on the equity side in a property that's going to be attractive to that pent up demand. So breaking down where the demand has fallen off, where the upside is, those are the type of questions we like to get into with our investors, David. And it has a lot to do with, what part of the market people want to be in. But again, this is not just Austin. These numbers are reflective of what's going on around the country. So the number of sales volume, it's not like it's only dropped in Austin. It's a nationwide, trend at this point.
Mm-hmm. Yeah. I mean, I would say that the Southeast, the Southern US has definitely been hit a little bit harder. Austin has done a really good job of building. They've been a model for a lot of these cities that have talked about housing unaffordability. And Austin has done a really good job of adding housing stock, more in the apartment sector. We've added more apartments than any city, basically, except New York City, which is, crazy considering how much smaller we are than some of these peer cities like a Chicago, Los Angeles, where we actually added more apartments than they did. So we've done a good job of keeping our affordability in line. And we've seen that with rents going down over the last 2 years. And that's
Right.
been good for people wanting to move here, people wanting to stay. So that's been a positive, although it definitely hurts people that own homes. And so that's where, people that want to sell their homes, people have had this alternative of renting, which has had a lot of extra supply. But when rates come down and it helps, even out the rent versus buy calculator, it's going to push a lot of people over to buying who would love to
Right.
own, and they just haven't yet because of the dynamics of the market. All right, I was talking to a partner on one of my deals. We were just diving into some of the stats, and I wanted to take a deeper dive on this chart here showing the average appreciation. So we're looking at, I believe I was looking at all residential within the city of Austin. So just to give you a sense of, here's annual appreciation. So we're going all the way back to the GFC, the Great Financial Crisis. And you can see prices bottomed in Austin with an average price in 2009 of 241,000, a drop of 3% on residential. And then it started to tick up 3% gain in 2010. The big bump here was 2013. We were up 8%. Then, some pretty strong years. And if you look at just the average from the GFC to COVID, we averaged 5.16%. And then, of course, we got the 11% jump in 2020, 30% in 2021, another 10% in 2022, which 2022 was kind of a tale of 2 years, two halves of the year. The first half, big appreciation. The second half, not so much, but it averaged out to 10%. And then an 8% drop in 2023, basically flat to 2024, and then basically flat to 2025. So if you do that, we're just under 5% is the annual appreciation rate across all of these years, so across these 19 years. So when you're thinking forward into the future and you're trying to make projections as an investor, a buyer, I think this is a really strong number to use. You might drop it down to 4% to be a little bit more conservative. But that just to give you kind of like a baseline understanding of kind of some of the stats. Now, what if we were to continue on this trend? Like this 5%, that was very consistent. Everybody liked this market. We didn't need to jump 11 and then 30%. If we had just stayed at a nice steady 5%, things would have been great. So what would that have looked like? So I basically over here, then I took our 399, right, in 2019. And I said, what if we just continued on this 5.16% trend? Where would we have been? And then year after year, 5.16%. We would have been at 420,000 in 2020, 441 in 2021. But where were we actually in 2021? We were actually at 578. So we were about 31% above that trend. Where were we in 2022? We were about 37% above the trend. And then in 2023, prices were down. So now we're only 20% above that trend line. If we continued on that trend in 2024, we should have been at 513,000. We were at 582 on average, so we were 13% below the trend. And so far in 2025, we're at an average of 589, and we should have been at 540, so we're about 9% above the trend, which isn't that far off from what we were from peak. We were talking about being 7% below last month, so we're really not that far off. And here you can visualize kind of what that trend line would look like, how far above we got, and kind of how we're coming back into alignment with the trend line. And so what does this mean for people? Well, if we look at these prices over the last 5 years, the peak being in 2022, an average of $640,000. Well, we're already, other than this 1 year, these are the only people that probably don't have equity in their home. People that bought in 2022. Of course, there's one-offs, people who maybe paid a little bit on the higher end of the range in 2021 or 2023, but on average, right? So we're already at 590. So anybody who bought, around this average, look at the averages for these years, right? We're already above those. So these people, right, they should have some level of equity or at least be at break even. Maybe they lose a little bit after transaction costs. So I think that's a pretty bright spot to say. I think I did the math and tried to figure it out, like what percentage of people would have bought at this price and would be at a loss right now. I took it in like the 5-6% of homeowners range. So it's a relatively small percentage. Of course, it's not fun for those people that are in that situation that would lose money if they were to sell their home. Doesn't mean they're underwater. What underwater means, just so people know, is that their loan balance is actually higher than the value of the property. that would be a pretty rare scenario. There weren't many people buying with 0% down. And so there's not many people underwater. That would be even less than the 5, 6%. But people that would sell at a loss if they were to sell today. And so then let's follow this trend line. Like, where should we be where we actually exceed the $640,000 average price? Sometime between 2028 and 2029. So by the end of 2029, this trend line, we would be above the all-time high price. So we got a little ahead of our skis there. And so I guess what I'm saying here is if you were to follow this trend line to 2029, I think we'll actually be above this by then. But between now and then, anybody that's selling and can walk away with a profit is still above where they would have been otherwise. And I think this is what I think of the psychological issue of people thinking like, man, I looked on Zillow, my home was worth $1.3 million a couple of years ago, and now it says it's worth $1 million. There's no way I can sell. I don't want to sell for a loss. Well, they're not selling for a loss. It's really hard psychologically to get past the fact that they could have sold for 1.3 and they missed that opportunity. And so I just want to show that we're still ahead of trend. If that had never happened, we had never seen this huge run up, that if you're selling for above some of these numbers, you're still doing pretty well.
Yeah, when I look at this data set, the way you've got it organized here, the thing that kind of jumps out at me is that the days of a steady stair step appreciation, call it on your chart, I'm looking here like 2009 to maybe 2018, 19, that beautiful ascension up that you could count on. I think those days are gone, and rapid appreciation followed by a flat market. What we haven't seen is rapid depreciation. And so, is that a possibility? Is it a likelihood based on the limited sales volume and the limited supply? What this basically tells me is that the trend of things happening fast, when the market heats up, it can seem like it's happening overnight, that it's just going to jump. And that's what I'm seeing here. I could maybe put it into a more succinct numerical reasoning as to why, but I think the combination of the volatility that we saw from the crazy sellers market that we had, and then the charts that you showed with the sales volume and the pent up demand, when it hits, I think it's going to hit hard, just like it did last time with a period of rapid price appreciation. When is that going to happen? Hard to say, but yeah, I think the days of the steady price appreciation in the Austin market are not going to return anytime soon. It's either going to be boom, bust, or flat.
Well, I agree, but also can take the counterpoint to this. The agreement would be that, yes, everything seems to move really fast since 2020. It's kind of all of a sudden it's up, all of a sudden it's halted. And I think that if rates come down substantially and quickly, which is very possible that the Fed holds off too long. There's lots of people saying the Fed should have already lowered rates, that inflation's under control. And if they all of a sudden realize, oh, we need to spur growth, well, unfortunately, real estate, and I guess in this case, fortunately, is the only thing that they can really turn is interest rates, which has the biggest impact on real estate. All this could take off again. The counterpoint to that is that if we look at this chart, this period here doesn't look that much different than the last crisis, the last real estate recession, which was the 2006 to 2009 period, where it was kind of flat, right? Kind of flat. And then we got back to trend, things started to catch up, and then we had our steady up growth rate. So if interest rates come down subtly at like a nice pace, we could just see this start to pick up and we kind of go back along a trend line. Now, will it be back to this trend line, or will we have like a new trend line here? I think it would be, this is to me is kind of a bad case scenario, is that we have to wait all the way for
Right.
this trend line to catch up in 2029 to our all-time high, which is here, right? So if you look forward, this is 2026, 27. So we're like out here. catching up
Hmm.
to our
Yeah.
2029 all-time high price. I think that's a bad case scenario. I think rates come down sooner. Pent-up demand pushes our trend line to probably something like here and going up. So I think it's just really interesting to see this nice steady trend line. And people are saying, like, oh no, we're going to drop back down to here. There's still people calling for the real estate crash and that we're going to drop down to these prices. Like, that to me just does not seem feasible that we would go well below this trend line,
Hmm.
right? This seems like a pretty strong indicator of where we should be. So, is there a little room to go down here? Yeah, there's a little bit, right? So we're only 9% above the trend. So, is there 9% room for prices to go down? Sure, that's possible if interest rates were to go up from here, but it's hard to imagine that we see us going back to 2020 levels at $444,000 average price. I don't think that's happening. So, I
Right.
don't like to use the word worst case scenario. So I'm saying bad case scenario for those of you planning is that I would say there's a 9%, nine room for prices to go down 9% from where they are now. And that's a bad case scenario. But I don't know that that's that likely, especially as time passes, we get to next year and our trend line should be 568. And I didn't do the math on where we are in terms of below that trend, but we could probably pretty quickly do that. So we'd only be just under 4% below that trend line. So that's my thoughts. Looking at the stats in a different way and trying to give you guys another insight. And I think just for a lot of people, this is an interesting chart to see these percentages over the years and what that averages out to between these periods and overall, and just see like 5% steady growth rate.
Yeah. Well, it's all about context. And if your only reference point is the peak number and you're comparing everything to that, you're obviously looking at a downtrend. But when you look at the data from a variety of ways, the way you've done it is an annual appreciation rate and extrapolate that out, you can see that, it's not doom and gloom. It's not the end of the world. It's just the complex world of real estate.